2 months ago, I made a video breaking down HIMS, and I told you I was adding to my position at around the $40 level. Well, today, as of the last close of January, we're at 31.32 cents. And that's down significantly from the all-time highs of nearly $70. We're talking a drop of over 55%. And yeah, if you're holding it, I get it, it hurts. But I've shared winners with you before, like SanDisk and Bloom. But here's the other side of real investing. Not every idea pops right away, and sometimes the market takes their time to catch up. And that's exactly where we are with HIMS. The key point here is nothing about my long-term view on the business has changed. I'm still holding every share. It's one of my top 3 core positions. And if I could find more companies with this exact setup, with massive platform potential, true diversification away from AI and this energy hype, and now beaten down way beyond what the fundamentals justify, I would buy them in a heartbeat. In my opinion, this is a company with genuine 10x upside if they execute things right. And right now, the market's overlooking that because everyone's chasing the obvious trades. So in this video, I'm going to walk you through 3 things. Why the sell-off has been so aggressive, and why I think it's mostly only temporary. Why my high conviction thesis is stronger than ever. Where I realistically see this business heading over the next few years. And by the end of this video, you'll see exactly why I'm still holding on to it, and why HIMS could surprise a lot of people from here. Quickly guys, if you're new here, hit that subscribe button for more no BS conviction ideas like this. Let's jump in. Why has this sell-off been so aggressive? If you're watching this and feeling the sting, you are not alone there. Take a look at the 1-year chart here. We've had an incredible run in 2025, peaking at around $73 back in February on the huge GLP-1 weight loss hype. But since then, it's been a steady grind lower. We're now sitting at around $31. That's down roughly 55% from those highs. In just the last few weeks of early 2026, we've seen multiple 4 to 6% drops in single sessions, with heavy volumes on the way down. The main culprit, the GLP-1 weight loss segment that fueled so much of the 2025 rocket ride, has hit a major speed bump. It exploded subscriber ad and revenue, but the key event flipped the script. First, the FDA declared the semaglutide shortage over back in earlier 2025, which restricted compounding in many cases. HIMS had a short-lived partnership with Novo Nordisk for branded Wegovy, but it fell apart over disagreements on compounded offerings. Now, branded supply from Novo and Lilly is flooding the market, and competitors like Amazon Pharmacy just rolled out low-priced Wegovy option, putting real pressure on pricing power and market share for telehealth players like HIMS. Result? Subscriber growth in this vertical tapered off sharply, from explosive levels in 2024-2025 to much slower ads. Average order values softened as some patients switched to cheaper branded alternatives. This wasn't a total collapse, but the market priced in a post-hype reality for compounded GLP-1s fast and pretty hard. On top of that, management has been upfront. 2026 is shaping up to be an investment year, they say. They've poured money into new talent and tech, supply chain upgrades, and international expansion. This front loading means near-term margin pressure. Gross margins have dipped, marketing spend is still elevated as a percentage of revenue, and analysts have called out that 2026 consensus estimates for growth and EBITDA look stretched and overly optimistic given the competition and spend. Other factors have piled on, of course. There's been a broader market rotation out of high growth health stocks into these AI and other energy plays. So we've covered the why behind the aggressive sell-off, but now let's flip the script. Why am I still holding every share of HIMS as one of my top 3 core positions? Why does my conviction feel even stronger after this pullback? First, zoom out to the fundamentals. This is where the story gets exciting. Despite the chart looking rough short term, the underlying business is still firing on multiple cylinders. Take revenues, for example. Trailing 12 months is sitting at around 2.21 billion. That's massive scale for the digital health platform. Just look at this growth trajectory. We've seen explosive year-on-year increases, with Q3 2025 alone at almost 600 million, up 50% from the previous year. Even with the GLP-1 slowdown, overall revenues are on track for multi-billion dollar levels, and the company guided full year 2025 to 2.3 to 2.4 billion before the dust settled. The subscriber base still growing towards 2.7 million plus paying users by the end of 2025, with heavy personalized driving stickiness, over 1.4 million using customized solutions in the recent quarters. Now the real kicker, valuation. At today's price, at $31, the price to sales ratio has compressed to roughly 3.5x, which is a massive way down from the 5 to 7x during the 2027 highs. This is a huge derating. From a high growth platform disrupting traditional healthcare with improving margins, positive net income, strong cash flows, and a path to 20% EBITDA margins long term, 3.5x price to sales looks attractive, even conservative compared to other telehealthcare or consumer health plays. The market has punished the near-term noise, but it's overly discounted, in my opinion. Product expansion into testosterone, menopause, longevity, peptides, mental health, labs, plus international ramps in Canada and the UK. So I think this is a genuine platform networking effect. Once someone is on HIMS for one thing, hair loss, ED, weight management, they often add more categories. Hers also is on track for $1 billion of revenue potential. AI personalization is also getting deeper, and management is investing aggressively in 2026 precisely to accelerate beyond the current headwinds. In my opinion, the asymmetry is massive here. If they execute, which their track record suggests they can, this legitimately has a 10x potential over the next few years as digital healthcare becomes the default for millions. The risks are real, of course, but the reward, in my opinion, is skewed heavily towards the upside. In the next section, I'll lay out the realistic roadmap from where this business could go over the next few years, including some key catalysts and the bull case for the numbers. All right, so we've covered the sell-off and why the fundamentals still make this high conviction hold. Now let's get realistic about where HIMS could go in the next 3 to 5 years. This isn't a pie in the sky, it's based on management guidance, recent launches, and the catalysts we see coming. So near term 2026, management have classed this as an investment year. We'll likely see the continued headwind early on. GLP-1 dynamic stabilizing but not exploding like before, plus heavy spending on talent, AI personalization, supply chain, and international ramps. Consensus expects revenue growth to be moderate short term, with margins compressed. Adjusted EBITDA around 13 to 14% range from recent updates. But the back half of 2026 could start showing acceleration. Key catalysts include testosterone and menopause, perimenopause offerings. These are already gaining traction with strong early products and market fit. Hers is on track to hit $1 billion in annual revenue in 2026. Second is lab expansion. At-home testing, personalization. This unlocks deeper insight and upsell opportunities. The third, what I'm excited about, is longevity and peptides. Launching in 2026 with on-market peptides, coenzymes, GLP, GIP blended focus on performance, recovery, and cardiometabolic health. This taps into the mainstream shift towards proactive, preventative care. And also lastly, international. Canada, UK, Spain, and most of Europe potential. Management see this as a $1 billion annual opportunity long term, with Zava contributing at least $50 million in the second half of 2026. So realistically, if management execute this well, 2026 revenues could accelerate back towards 40% plus growth as new verticals ramp and GLP-1 stabilizes. By 2027, 2028, we should see margin expansions heading towards the 20% plus adjusted EBITDA from scale, vertical integration, and the long-term bull case here, with management's own target, they're targeting at least $6.5 billion in revenues and at least $1.3 billion in adjusted EBITDA by 2030, which is obviously implying massive upside if they capture even a slice of the digital health market. I think it's also important to say that even though they can be wrong most of the time, analysts' average 12-month price target sits around $43 to $45, with actually a high of up to $85, suggesting anywhere from a 35 to 160% potential from here. And of course, risks are real. Competition intensifies with Amazon and branded pharma coming in. The drop has priced in a lot of the near-term pain, while the platform's diversification, personalization modes, and proactive investment positions it to surprise on the upside. If they hit even a good portion of these milestones that the management are talking about, this could be such a great entry point. This is why I'm holding strong and why I think HIMS could be one of the biggest stories heading into the rest of 2026 and beyond. So to wrap this up, yes, the sell-off in HIMS has been brutal. I'm still holding strong. It's one of my core top positions, and if anything, the pullback has made the opportunity even bigger. I'd really be interested to know if you're holding HIMS, so do comment below. Are you adding to this dip, or are you sitting on the sidelines for now? I read every comment and love the discussions with you guys. Thank you so much for watching. Stay patient, stay convicted, and I'll see you in the next video. Take care.